Good afternoon, everyone. Happy Monday and welcome to the latest webinar in our ISA season event with Elsa Craig, one of the managers of International Biotechnology Trust. IBT has performed very well over the past year as the biotech industry has rallied sharply after a few years in the doldrums. IBT itself is the top performing specialist biotech trust over 1, 5 and 10 year periods. As we highlighted in a note that we published last week and you can find on the website. Before I hand over to Elsa, just a reminder that if you'd like to ask a question, we have plenty of time at the end. You'll need to write it into the box on the right of your screen and I'll put those questions to Elsa when we have time. So Elsa, over to you.
Thank you, Thomas, and thank you very much to Kepler really for giving us the opportunity to speak to retail investors directly, which we value a lot. So our retail interest has increased over time, over the last sort of 10 plus years. And we're very grateful for your support and welcome any new listeners that might be dialing in today. So as Thomas said, I'm going to talk through International Biotechnology Trust, which is a ticker IBT, ahead of ISA season. And so just as an introduction, this sector has been slightly out of favour for a number of years since COVID, where we saw a big surge in valuations. That was driven by excitement over treatments and vaccines during the pandemic. Since then, the couple of years coming out of the pandemic, we did see a drawdown. And that was driven by 3 reasons. And I can quickly run through that as a reminder for those of you who are new to the story and why we're seeing a recovery recently. So those 3 reasons were initially a pullback on valuations. The second reason was interest rates rising over a relatively long period of time. And biotech are long dated assets, meaning that cash flows are expected in the future. And so if you discount back at a higher rate, valuations will be impacted. So interest rates, which were raised because of inflation rising, kept a lid on the sector. The third reason was because of politics. So Trump coming into power over in the US was a bit of a surprise at the time. And he appointed a controversial leader of their Health and Human Services division. And there's been a bit of sort of uncertainty on that front. However, all those 3 issues are very much sort of behind us in our view. And then we saw a big pickup in M&A last year. And all those factors have come together to see the sector performing well again. And we think we have a good outlook going forward. So after 4 years of consolidation, last year, the biotech sector was up 24% in calendar year 2025. And our trust IBT was up 47%. Interestingly, the fundamentals behind the scenes is that biotech is really taking over as the innovative engine of the pharmaceutical industry. And this is borne out by the numbers. So over 40 drugs last year out of 55 approved by the US regulator, the FDA, emanated from biotech companies. And this is driving interest from big pharma who have huge cash stockpiles, and they've been buying up many of these biotech companies. So last year in the fund, we had 9 companies acquired from larger pharma companies, and the industry as a whole had a bumper year in M&A. Now, we think these themes will continue in the coming years. So as an overview of the trust, IBT is a closed-ended vehicle. This gives us lots of different tools we can use to benefit shareholders, such as those who own IBT, in that we can pay out a dividend every year, and we do 4% of NAV each year, paid out in 2 installments of 2% and then 2%. We can also gear up. So when we see volatility in the market that really we don't feel affects our companies individually, we can use our gearing facility and gear up the fund. And just as an example of that, last year in April, when we saw Liberation Day and the impact on equities as a whole, biotech was not was included in that, and we saw a marked sell-off. So we geared up the fund up to just under 20%. This was the highest gearing position since 08-09 period during the financial crisis, when we felt equal amounts of fear at the time, if not more. And that helped us really capture some of the upside coming out of Liberation Day, and helped drive a lot of that relative outperformance, along with the 9 companies that were acquired out of the trust. So this slide just shows an overview. I mentioned that biotech is taking over as the innovative engine of the pharmaceutical drug industry. Performance, as Thomas mentioned, to the end of December, the fund has outperformed the benchmark, the Nasdaq Biotech Index, over 1, 3, 5, and 10 years. And then, just as a little aside, Marek, my co-lead fund manager for the trust, took over the fund as lead fund managers in 5 years ago, Friday, just gone. So we're on our 5-year anniversary, and it's lovely that we're very pleased to announce that we've outperformed over that time period. Volatility-wise, we've managed to keep a lid on volatility historically. I can talk to how we've done that. Obviously, this doesn't mean that we will be less volatile going forward, but certainly historically that's the case. And then yields, I mentioned the 4% out of capital. It's an investment trust, and we can do that. Gets paid out to our shareholders each year. Expert team, I can just come on to that on the next slide, in that we've both had, Marek and I, a very extensive period in this market, both in industry and in the capital markets. I can go in a bit more detail on the next slide. And we moved to Schroders. So we've been at Schroders for coming on to 3 years now. We moved over there in November 23. So a bit of background as to who we are. I joined this trust in 2006, so approaching 20 years working on IBT now for myself. Prior to that, I worked at large buy-side firms such as Rothschild, Insight, and Barings. My background is that I'm scientifically trained, and I bring a great deal of experience now from various different cycles to the table. Marek comes from a different background, in that he was actually worked in the biotech industry. He's worked in business development in the biotech industry and done various deals himself. He's also founded multiple biotech companies and exited 2 of those. So he really does bring a different sort of mindset to the table when it comes to investing in this very difficult sector to invest sometimes. I urge you to read the disclaimers on this slide. They will be put up on the website if you want to have time to look through those. So taking a step back, we mustn't forget that generally the drugs that are being made at the moment can help the population who are sick. Now, sick people tend to get more sick as you get older, and this chart just reminds everyone that over the next few decades, we are going to see a marked increase in the proportion of elderly people in the population. This will therefore be increasing the demand for new drugs and new innovations to address diseases. The next slide just shows, as you do get older, these various different ailments will affect you more, unfortunately. So heart disease, cancer, Alzheimer's, and stroke. And as we have, as a society, addressed heart disease really quite well in recent decades, people are therefore living longer and more susceptible to getting things like cancer and Alzheimer's, both areas that we're invested in. So moving to the supply, the way I'm describing this here is we're having demand for drugs and medicines, and it's met by the industry, the biotech industry, and the pharma industry by addressing unmet medical needs and launching new drugs. Now, this slide shows 2 shaded areas, each bar of the histogram over time. The dark blue shows the drugs emanating from biotech companies, and the turquoise are from pharma companies. And you can see the proportion since 2013 has increased markedly for biotech. So this is evidence to show that innovation is coming from biotech companies and less so from internal pharma R&D. So more than 70 drugs, again, 2024 was the same, coming from biotech. This slide shows that big pharma are having, have got a major problem ahead of them. Every year, we're having a huge number of drugs coming off patent and being subject to generic competition. So this is hundreds of billions of dollars coming off patent with two bolus years, 2028 and 2031. Now, what does this mean? This means that pharma absolutely have to replace these replenishing revenues, and that's why we saw a big tick up in M&A last year. This slide shows a list of biotech companies very much in our space with their projected consensus sales until 2034. So you can see why we're seeing an increase in M&A. The highlighted, if you can make out on the slide, there's red dotted highlighted sections of each bar, and those are the companies that have already been acquired in the recent months, and the rest remain independent. Now, we think that if you remember the previous slide, pharma's problem with IP expiries, this very much is the reason why we're seeing biotech companies get acquired. Last year, we saw a bumper in M&A. Again, this is just data to back up what I've been saying throughout the presentation so far. So in terms of numbers of deals, we saw 40 acquisitions across the sector in 2025, and 9 of them were in IBT. This slide just shows that the market has been relatively flat in recent years. And then last year, finally, we saw a nice recovery driven by the fact that the concerns over tariffs and drug pricing, etc., are behind us. And we saw generalist interest come back to the table. We've been in sort of a down to flat market for interest rates, and obviously this increased surgence of M&A, and we're seeing a nice recovery. So that section really is about the biotech sector and why we like biotech generally longer term. The next section will be talking about how we as IBT invest in biotech and what's different about us versus other specialist funds. So here is our investment process. We do take a top-down view when we make our investment decisions. And what do we mean by that? Well, what we don't do is buy and invest in a company, hold it for 10 to 15 years, and hope that their technology or asset remains the top best pick at the time. We think things change a lot, so we do trade around the different individual positions, but we also take a top-down view in terms of the business cycle. So when we took over in 2021 as lead fund managers, we were facing very bubbly valuations, and we decided to tilt the fund into profitable, more defensive companies, which you can find in the biotech industry over in the US. And that helped us protect capital when we saw a drawdown in valuations. We then felt that interest rates would probably have to rise because of rising inflation, and we therefore continued to hold those relatively defensive positions. And then when valuations looked very attractive to us around 2022 time, we tilted the fund into earlier stage companies. And where we're positioned at the moment is a little bit in between those two areas, and I'll come on to that in a bit more detail in the future, in a few slides. And then in terms of idea generation, we do travel to the US a lot. We have a lot of calls with our US companies. We meet about 200 companies a year. That's not new companies, it will be the same companies over and over again as well. And we have access to a wide range of key opinion leaders, and we can pick up the phone to them as and when we want specialist input into our investment ideas. In terms of risk mitigation, one thing we do try and do is avoid losing capital. And we've always tried to do this at IBT. What we don't like is holding great big positions, say in our top 10, going into a binary event and losing capital on a failed clinical trial. Another thing that differentiates us, we're very valuation sensitive. I mentioned we moved out of certain areas back in 2021 when we felt valuations were too high. Even though we love the companies or the science was great, we will take a sidestep out the room if we feel that things have got too bubbly. And we have trading discipline, and those two factors are very much linked. In terms of how we approach different disease areas, Like I mentioned, we're not a buy and hold strategy. We don't think that's the best way to approach this sector. If we think there are various different interesting scientific approaches to a specific disease, we'll own all of them in a basket. And then as and when data is read out, we can sell the ones that didn't work or weren't the best and put that money to work and build a position over time. Here are some examples of areas that we're invested in. We're invested in many different areas. This is just a few examples. I'm going to call out rare diseases. So rare diseases is, so for those who don't know what they are, so a rare disease is when a disease afflicts a small population. So for example, cystic fibrosis or particular genetic mutation-driven diseases. They often affect children and they're incredibly high unmet medical need with very few treatments to treat them. So we like this area because governments and authorities have been trying to encourage investment in this area. More than 20% of drug sales in 5 or so years' time will be made up of rare diseases as a whole. So it's a big market, even though each individual disease is a relatively small market. Often the biology is well understood. We're seeing a lot of M&A interest in this area. And we generally like this area as well because of the incentives, such as the Inflation Reduction Act, which was introduced under Biden, has actually ring-fenced rare diseases as an area that will not face Medicare drug price negotiations. That, and on top of some priority review voucher mechanisms that the US administration has inputted, where manufacturers can speed up the time for approvals, we think this area is really a rather nice area to be exposed to. Emerging oncology, I think, speaks for itself. There's still a huge high unmet medical need in cancer. M&A targets, I think many of the companies that are invested in are targets for big pharma for the reasons I've mentioned, and central nervous system. So this covers diseases like schizophrenia or depression. So I mentioned that we are we do a top-down fund management process at IBT, and here it shows where we're positioned at the moment. So at the moment we like late-stage, clinically de-risked assets that may have been launched already or about to launch, on the cusp of launch, and that's in this shaded area here. The slide itself shows the life cycle of a drug from drug discovery all the way up to generic competition, patent expiry. And the pink shaded area is where we're exposed to at the moment. We think it's relatively de-risked, and we think that's exactly where pharma are shopping. And why is that? It's because their revenues that are going to be subject to generic competition are very much around the corner. If you remember the years 2028 and 2031, these guys don't have time to develop a drug from scratch to replace those revenues. So we're positioned here at the moment. Here's a slide just to show the M&A transactions we've had going back to 2020. On average, it's about 4 or 5 deals a year. Last year, we had a big bumpy year with 9 companies acquired. And this year, we've had our first acquisition announced a week or so ago with Day One acquired, which is an emerging oncology company. It's just recently launched a drug in a form of brain cancer in children. Here we have a list of names that we've pulled out and called them Biotech 2. So here, this is companies that can actually stand alone on their own 2 feet and launch a product. They don't have to be acquired. They don't have to partner. And we really like this space. This is the pink shaded area I mentioned earlier. And if you were to say buy the ETF, then you would get just under 7% exposure in your ETF of the Nasdaq Biotech Index in these names, whereas we have just under 30%. And as I mentioned, we think that this is where pharma will be shopping, and one of those names has already been picked up. Often these companies are in rare diseases. I mentioned that before as an area we like. We like it also because companies don't need great big sales forces to distribute and manufacture drugs when you're dealing with a very small patient population. So here's some fund stats. Just under 80% of our positions are based in the US. 65% in revenue growth and profitable companies. So this means that when you're talking about traditional white coat biotech companies, that makes up the remainder of the fund. So they're very de-risked, sort of high growth companies that we're invested in. and not so much the earlier end of the market, and just under a third in rare diseases. Here with just a graphic again, just showing you the proportion of the fund in these clinically de-risked assets. Another sort of additional benefit of a closed-ended vehicle is that we can invest in private companies. We have a board of directors, and they would like to have exposure of between 5 and 15%. At the end of December, we had 6%. And we do not invest in individual unquoted companies, we invest in funds. We felt that decision was made 10 years ago to invest in funds because performance was better than individual companies. So it's very diversified, but gives you, the shareholders, access to this part of the market. This slide, I think, is important just to back up what I was saying at the very beginning, which is that we do see an inverse correlation with interest rates and the biotech market. If we see interest rates, we were originally expecting interest rates to be flat to down this year. That might change with what's going on geopolitically. For us, it gives us a good opportunity to gear up again, should we so please. So we'll watch this space. But here you can see the turquoise line and the dark blue line are yields and the biotech performance. I mentioned about politics being the third punch as to why the sector remained in a bear market for quite so long. And we feel that MFN, which is drug pricing, and tariffs are very much interlinked. When Pfizer did their deal with Trump on these issues last year, the sector had a relief rally. And since then, we've seen many different deals with the large pharma companies. And the sentiment is that these issues are very much behind us and sorted out now. One area that's still causing a bit of turmoil is the FDA. So we're seeing a lot of turnover there. We've recently seen someone leave last week who was the head of CBER. So we're awaiting the new appointment there. However, looking at the slide showing drug approvals, things seem to be ticking along and drugs are still getting approved, but it is an area that's still giving us some sort of concern. And finally, in summary, the sector is now in a recovery phase. We're very optimistic on the outlook and this year and going forward. We've seen an increase in M&A, which is no surprise considering the need that pharma has for new revenues to replace their generic competed drugs. Biotech is now the innovative engine of the whole of the pharmaceutical market. We don't think that will change. The fund itself has had 4 years of consecutive outperformance every fiscal year since Marek and I took over in March 21. Our discount has nicely come in actually just in the last few months or so, but as and when it comes out, we do buybacks. And we are positioned, like I mentioned, in these late stage de-risked companies at the moment. So thank you very much for listening. I'm going to hand over to Thomas now and we will have some questions.
Brilliant. Thanks very much, Elsa. We have a couple of questions already, but if you're in the audience, please do put your questions forward. We have plenty of time. One question. So we saw the deal for the acquisition of Schroders by Nuveen. Is there anything you can tell us? Is this going to mean anything for IBT? Is there anything you know at this stage, if it means anything for how the trust will be managed?
Yeah, so what's been interesting about this acquisition is that not many people had heard of Nuveen. So we've done lots of homework since then. I think the situation generally has been taken that we are going to it's going to be business as usual. And Nuveen and Schroders have a very much Tetris-like match make. So the only reason that this deal's even happened is because of that fact. So Nuveen needed European exposure and Schroders wanted to have US exposure and capacity. So it's a very neat match. The deal hasn't been driven by, inverted commas, synergies, so cost savings. It's more a consolidation in light of the longer term effects going in the asset management industry. We have been told categorically that nothing will change for us, at least in the next sort of 2 or so years. And if we do see change, it's probably going to mean something beneficial in that we'll have this US arm we can refer to. And obviously that's very helpful for us because we're very much US centric in the fund at the moment.
Thanks. And you did discuss a little bit what you've done with the gearing, but could you perhaps just give us some words on exactly what the level is at the moment,
Yeah.
and what that reflects?
So what we tend, I mean, we like gearing. Long-term biotech, over the long term, in normal periods of time, outperforms healthcare, and healthcare outperforms equities, and equities over the long term generally go up. So gearing for us makes sense. As we said, we do use it actively. So back in Liberation Day, when the sector fell off quite sharply, we geared up to a great extent, which is not very usual. We wouldn't feel comfortable with that sort of level of gearing. At the moment, we've got a normal level of gearing, so high single digit, and we would go to we'd never go to cash, but we might go to low single digit if we felt things were very bubbly. And at the moment, we're bang in the middle, kind of normalized gearing level.
In terms of the geographical focus of the portfolio, it seems very US centric at the moment. I think you said it's 79-80% in the US. Is that right? Are there any views on Chinese biotech or any plans to diversify into other geographies?
Yeah, we've had Chinese exposure. We've got about 5% on rises and falls. The way we've approached the Chinese biotech market is to invest in companies that have listed in the US on NASDAQ, and that way we get some level of comfort with the various different regulatory rules and regs that they have to abide by when you list on NASDAQ. So we do have Chinese exposure. We're watching this space very carefully. At the moment, it's definitely more early stage, and we're yet to see genuine innovation come through, but we think it's not, in a number of years that will definitely come through. So it's very much watch this space.
When it comes to the private companies or the unlisted companies, why do you choose to to invest through funds rather than directly?
Yeah, I think it gives diversification. And also, we found when the board made this decision 10 years ago in 2016, we found out that going into direct investments didn't perform as well as the funds. And the most recent investment is now via Schroders Capital, who has access to the best top tier funds in the US. So we're very comfortable with that.
What is different about the unlisted companies to the public companies? Are they earlier stage, or do they have a different quality or different? Is there anything else different about them?
They're earlier stage, exactly. The latest funds we've invested in have been crossover funds as well. So coming to the end of their private life and about to list. So that gives us a bit more of kind of IBT-like risk profile. We won't go super duper early. So into drug discovery, that's not where we're investing. It's more the later stage of the cycle before the IPO window opens.
Is there greater return potential then if you get these companies early?
Exactly. Venture tends to be higher risk, higher return. But that's why we want only a kind of a 5 to 15% weighting in the trust as a sweetener, rather than for it to dominate the trust.
And a couple of people picking up on our conversation about geographical diversification. So the other 20%, where is it invested at the moment? And we spoke about China. What about India? Is there any biotechs in India?
Tends to be more generic in India. And always has been. So again, not so much innovation. What we try and do with IBT is give our shareholders access to genuine innovation. And where we see that, that's where we will invest our money, your money.
There's a question here about how you would compare your trust to others in the sector, which you may, I don't know how much you would want to say about that, but I could supply some comments if you don't. So, for example, how do you compare to the other trusts in the sector?
Yeah, I mean, it's very difficult talking about competition. I think you can just have a look at performance. That's what I feel. Just go home and log on and have a look at long-term performance over all the trusts, and then you can see there is a lot of difference. Where we're positioned at the moment is quite similar. I think everyone's recognised that pharma are going to pick up a lot of these companies that are kind of later stage biotech. So that's not that different. We were quite different in 21 when I said we moved to larger cap companies. I think we were we went out on a limb then.
Yeah, and I would add our notes on IBT and others will talk a little bit about this, so that'll be a good place to see some comments on what happened in over the past 5 years in terms of relative performance. So you said something interesting about the number of drugs that are coming from the biotech industry rather than from pharmaceuticals, and how this is a much higher proportion than there was in the past.
Yeah.
Why is there this difference? And is the danger that this could revert, or is there something structural here?
I think it's structural. So if you think about it, when something's invented, ideas and discoveries happen at university. And a lot of the companies that are born out of university, and then they form small companies. They get seed capital from venture funds, and then they list on the stock market, et cetera, et cetera. And you can't really force innovation. You can't get a group of scientists together and say, right, you've got to discover this and that in this disease. It's very tricky. And I think pharma has recognized that, and they've pulled back on their R&D budgets because it's an easy cutback versus where you can really see a benefit with spend with manufacturing and sales and distribution. R&D is a much more difficult thing to really pinpoint your returns. And so I think that has been a structural change at R&D. And yeah, I think investors are recognizing that as well. I remember when Sanofi announced they were going to shift their strategy more back into R&D, their share price fell dramatically. So I think the recognition is that biotech are just better at it.
And you spoke a bit about the strategy of selling down a position prior to binary events. Yeah. Could you just tell us a little bit about how that works in terms of how much of the gains do you forego by doing this? What's the calculation?
It's very difficult because not every single case is different. We were talking to a client about this last week. It's incredibly nuanced. So, for example, there might, on the occasion that we think that there's absolutely no expectation this trial is going to work or show something interesting, we might even hold it. What we don't like to do is hold more than a 1% position in going into that sort of binary event. But we did do that with Unicure, for example, and no one did expect those data to look interesting, and they did, and the stock was up a huge amount because of that. So that's a slightly unusual situation. For a classic binary event, we think that often it's mispriced. If there's high expectations it's going to be safe and effective, then we will just sell down our position, step to the sidelines, and if let's say it does win, it does hit, then we would rather buy back at a higher valuation and take off that risk, because if a trial fails and the share price goes down 80%, you're not getting that money back. So it's a very difficult question to answer because each case is unique.
Unicure was a great win for the trust last year. Maybe some of our listeners aren't totally aware of that. Could you perhaps just briefly explain?
It's been hugely volatile. So after those data read out that looked positive, and the trials of gene therapy for Huntington's disease, which is a desperately sad indication for those of you who know about it, there are no treatments out there. It's miserable. And this gene therapy showed some trends and signals that their approach was slowing the progression of disease. So everyone got terribly excited. The trial was actually done in the UK. It was on the BBC News as well, which is exciting. We felt at that point, however, that the regulatory path looked uncertain. So we, effectively a binary event. So we sold our position going into that. And since then, it's been hugely political. This particular company and asset, we're very much on the sidelines, really.
Great. And are there any examples of times that you've held a stock and it's had those poor results, and how do you react in those cases?
Well, it's the nature of the business. So we get I mean, every day actually we get some sort of news come out, and this is why it's a very labor-intensive investing in biotech. So, for example, at 12 o'clock every day we'll have readouts. We've just had one company read out 35 minutes ago, an obesity company with their data. Yet to see what the share price reaction is, but this is our sort of day job. If sometimes you can have a readout and we disagree with the share price reaction. So one of our positions, Vera, in a kidney space, had announced their data. This is 2 or 3 years ago now, phase 2, and the share price crashed, and we didn't agree with that interpretation, and we bought a lot of it on the back of that fall. And since then, that has been a real strong performer and helped our performance markedly as well. So we can disagree with the market and take a view. But inherently, it's happening every day. So this is a volatile sector and very news heavy.
So we've heard a lot about the potential in artificial intelligence, and one of the things that it's been touted for is medical research. Some of us may even have used ChatGPT to diagnose aches and pains. I don't recommend it, but it's an option. We have a question about whether there's any AI drug discovery currently. Is this a theme in your industry, and is that something that is providing investment opportunities?
I mean, every single earnings call, someone is talking about how they're using AI to speed up the drug development process. Its application across the whole of the life cycle of developing a drug, from drug discovery. If I go to this slide here, so AI can help, for example, screen many more compounds than in the past, maybe look for structures and targets that have shown tox in other trials, etc., and maybe eliminate failures earlier on. Finding patients for clinical trials can become much more efficient. Crunching the data out, coming out of a clinical trial, can be more efficient. The clinical trial itself is a regulatory requirement. You can't speed that up. That's it's probably something that isn't going to be improved on a timeline wise. And then I think a great deal that we're seeing now is being able to diagnose patients more effectively and efficiently. So if you can imagine one pathologist looking down a microscope for cancerous cells versus having a scan and comparing to many different scans that have been taken over the world and looking for a particular tumor, that's certainly got a huge role that we're seeing now. And then once the drug is launched, finding patients that might benefit from a drug, I think there's a role there as well. So absolutely has a role, and increasingly so going forward as well.
Excellent. Got one more question in the hopper, but if you're in the audience, please do. This is your last chance, if you like. So if we look forward, obviously it's been a good year, but a bit of a flat period recently. If we're looking forward, what do you think the sector really needs to kick on from here and continue the rally? What are the key things that we should be watching for?
I think what's great about this sector is that over time the innovation has grown and compounded, and this has been going on when the capital markets has, for whatever those reasons, I went through them at the beginning of the call, ignored biotech. But in the background, there's been many different discoveries, and the whole sector has moved forward. So we're seeing real, genuine value here. I think what we will need to see to keep generalist interest is a continued flow of M&A. And those of you, if you did dial into the JP Morgan wrap up, Marek and I did a webinar in January after coming back from the largest healthcare conference in the world in San Francisco. The bankers there were saying that they're even busier this year than they were last year. So I think we do need to see a steady stream of M&A, and we need to see strong launches. Many of these companies I mentioned in biotech too have launched, and their sales are doing really well. That needs to continue and keep momentum. Geopolitically, I think, as with any sector, but more, definitely biotech, we want to see some sort of stability there as well. So, that's a case of a short-term issue, but the great advantage we have in IBT being closed-ended is we can gear up. If we think we see a big fall in share prices, we can use our gearing facility to capitalize on that.
Fantastic. I have a final question come in about the obesity drugs that you mentioned in passing. Is that still an area where we're seeing innovation? Obviously, they're prevalent now. Are there still new drugs coming to market?
There are, and there are pitfalls to the current offering. The company I just mentioned actually was an obesity company that just announced data 40 minutes ago. Yes, so the innovations are tolerability. So a lot of people drop off after a year. So and then they put the weight back on, and sometimes put the weight more on. So I think we need to see better tolerated drugs, and that's absolutely where a lot of the focus is. Efficacy as well, Ozempic's efficacy is okay. It's not as good as Mounjaro, but improvements on that is fine. Maybe drugs that don't that cause weight loss, but only from fat and not muscle. At the moment, these drugs that you're all familiar with are reducing muscle mass in people. So there's lots of areas that we can improve on, and biotech certainly is in the forefront of that.
Fantastic. Well, thanks very much, Elsa, for the presentation and for all those answers. I think you gave a really good case for owning this specialist sector, which is there aren't very many ways to access it, certainly compared to more conventional equity sectors. Thank you very much to the audience for your interest, and a recording of this webinar for those who arrived late will be up on the website in the coming days, and hopefully the presentation slides too for you to download and look at again. Thanks once again for your interest, and thank you, Elsa. Hopefully we'll see a lot of you at our next webinar. Thanks very much.
Thanks, Thomas. Thank you, everyone.
Bye.
Bye.